If I had to step into this market today from scratch, knowing what I know about what is sitting directly in front of Palantir, Nvidia, SoFi, Tesla, and one of the more explosive AI infrastructure names this week, I would not be approaching this like a lazy little buy anything with a ticker moment. I would do it very differently. Today in New York, it is Monday, April 20th, and before we go any further, comment the day and the date you are watching from. And if you value the work I put into these breakdowns, support the channel by subscribing and by commenting John A.G. Best. That helps more than most people realize. Because here's the thing. The market has been acting like it wants to go higher, but it has also been acting like it could change its mood in a heartbeat. Just a few days ago, the S&P 500 and the Nasdaq were printing fresh record closes on hopes that the worst Middle East stress had cooled. Then over the weekend, oil jumped again as the US-Iran situation turned shakier and traders started reassessing how much relief was actually real. That is not a calm backdrop. That is a backdrop that rewards selectivity. And that is why I think a lot of people are looking at this market the wrong way. They think if the index is strong, then the work is done. It is not. A rising tape can hide bad entries, weak balance sheets, fragile narratives, and overloved names that are one disappointing conference call away from falling down the stairs. So the goal here is not to fall in love with the market. The goal is to identify where the next move could still have fuel. Now, broadly speaking, the artificial intelligence trade is still alive. It has not disappeared. It has not quietly died in a corner. In fact, Reuters has reported that major U.S. tech companies are on track to pour something in the neighborhood of $650 billion into AI this year, while other recent reporting pointed to roughly $635 billion planned for data centers, chips, and related infrastructure before the Iran shock complicated the energy picture. That matters because when the spending river stays wide, the companies tied to software demand, silicon demand, compute demand, and power demand can all keep catching water. But I want to push back on one thing right away. Big spending does not automatically mean every AI stock is smart. That is where people get sloppy. Massive capital expenditure can support the winners while still crushing weaker operators, especially if financing tightens or expectations get too silly. We saw versions of that in other booms. So yes, the theme is real. No, that does not mean common sense is canceled. Let's start with Palantir, because this is the one where the calendar and the story are starting to squeeze together. Palantir already told the market that first quarter results will be released on Monday, May 4th, after the close. Earlier this year, the company reported fourth quarter revenue of about $1.4 billion, with U.S. government revenue jumping roughly 2/3, and it guided first quarter revenue to around $1.53 billion, while laying out a very aggressive full-year outlook. Reuters also noted that even after a huge multi-year run, the stock was still down in 2026 because investors were wrestling with how much growth is needed to justify that valuation. That right there is the setup. On one side, you have real momentum in the business. Government demand has been strong. Commercial enthusiasm around AI products has stayed strong. And the company has shown it can turn headline attention into actual revenue at a scale that is now impossible to ignore. On the other side, the stock is not getting graded like a normal company anymore. It is being graded like a premium story. Premium stories do not get punished for being bad. They get punished for being merely good. So when I look at Palantir, my bullish case is pretty simple. If the company prints strong numbers, talks confidently about demand, and shows that margins are stretching the way investors hope, then the market can keep making peace with the valuation, because earnings growth starts doing some of the heavy lifting. That is how rich multiples calm down, without the stock having to collapse. The E starts running harder. But here is the skeptical side, and I think you need this too. There is a lazy bullish argument that says Palantir is untouchable because it has government relationships and because AI is hot. I do not buy untouchable. Government ties are useful. Commercial adoption is useful. Brand strength is useful. None of that makes a stock immune. If the next report lacks fireworks, if the call sounds less confident, or if the pace of adoption feels a little less dramatic than the market wants, this thing can get hit. That is not bearishness. That is just respecting the bar. Still, the bigger backdrop helps. Recent Reuters reporting on ASML and TSMC showed the AI build-out is still pushing hard enough for equipment suppliers to lift outlooks and talk openly about demand outstripping supply. That does not prove Palantir wins automatically, but it does tell you the wider ecosystem still has real oxygen. And Palantir is not trying to sell a dream into a dead spending cycle. It is trying to monetize software demand while the biggest players in the world are still racing to build. Now, Nvidia matters here too, even if it was not the deepest part of the competitor outline. Nvidia is still the temperature gauge for the AI trade. If Nvidia stays strong, the market tends to stay willing to believe in second-order winners. If Nvidia cracks badly, everything downstream starts getting questioned. That is just how this theme works. And with spending plans still enormous, I think Nvidia remains a tailwind symbol for the whole group, not just a single stock. It tells you whether the market still believes the shovel sellers are in control. Next is SoFi, and this one is a completely different kind of story. Palantir is about expectations, valuation, and whether growth stays outrageous enough. SoFi is more about whether the market finally gives the company credit for a business model that has been maturing right in front of everyone. Earlier this month, SoFi confirmed that first quarter results are scheduled for Wednesday, April 29th. Back in the latest reported quarter, Reuters said adjusted revenue climbed to a record roughly $1 billion, while profit more than doubled, helped by strong loan demand and fast growth in fee-based businesses. The company has also recently said it now serves about 13.7 million members, that Galileo supports roughly 128 million global accounts, and that new loan platform agreements announced in March totaled more than $3.5 billion. That is not nothing. What I like about SoFi is that it is not relying on a single magic product. It can attract people early, keep the interface simple, build trust over time, and then gradually deepen the relationship. Savings, spending, borrowing, investing, platform revenue, servicing, cross-sell. That model can look boring to people who only care about one explosive quarter, but over time it can become very powerful because the customer relationship gets wider, not just deeper. And I think that is where a lot of investors miss the story. They want an instant reward. They want the stock to behave like a meme and a compounder at the same time. Usually you do not get both. A lot of the time the market ignores a model like this until the revenue mix, profitability, and scale become too obvious to deny. Then suddenly the same people who were bored by it start calling it a hidden gem. It is never hidden by then. They were just asleep. Now let me give you the counterpoint, because SoFi bulls can get a little dreamy too. This company still lives in the real economy. If the consumer rolls over, if delinquencies worsen, if funding conditions get uglier, or if demand gets weaker in the wrong parts of the lending book, the stock is not going to float above that. SoFi is well run, but it is not living on the moon. It still has exposure to economic reality. That matters. Even so, I understand why people think the stock can keep recovering from here. Because the company is building fee-based, capital-light lanes alongside the classic lending engine, and that mix matters. It means SoFi does not have to win only one way. If management keeps executing, the market may finally start valuing it less like a plain lender and more like a multi-engine financial platform. That re-rating is where a lot of the upside argument comes from. Now let's talk Tesla. Tesla reported earlier this month that first quarter production came in a little above 408,000 vehicles. Deliveries came in at about 358,000, and energy storage deployments reached 8.8 gigawatt hours. The company also said first quarter financial results will be posted after the close on Wednesday, April 22nd. So once again, this is not some vague someday catalyst. It is right here. And Tesla, as always, is two stories at once. One story is the actual business: deliveries, margins, energy, software potential, autonomy language, factory execution. The other story is the Elon factor. The reason that matters is simple. Tesla does not trade like a normal industrial company because investors are constantly trying to price both present operations and future optionality at the same time. When the market gets excited about the future, the stock can levitate. When the market gets annoyed with the present, it can sink fast. I do think there is opportunity here. But unlike some people online, I am not going to pretend Tesla is easy. It is not. If the company gives investors a reason to look forward again, the stock can move hard. If the quarter reinforces concerns around growth, pricing pressure, or execution, then the path gets messy again, and the personality risk is real. When a single individual can redirect the emotional weather around a company this much, that is risk whether bulls admit it or not. Then we get to the tactical name IREN. IREN has become one of the cleaner ways to express the idea that AI demand does not stop at software and chips. It also needs compute, land, cooling, and above all, power. The company has highlighted a major long-term Microsoft AI cloud agreement worth roughly $10 billion, said it expanded targeted AI cloud capacity to around 150,000 GPUs in March, and continues to emphasize large-scale renewable-powered data center development in the United States and Canada. That is exciting. It is also risky, because this is a capital-intensive build story. It depends on execution. It depends on timing. It depends on demand staying real. It depends on counterparties, infrastructure, and financing all cooperating enough for the thesis to keep moving. So I completely understand why someone would rather trade around a name like this with a wheel strategy than just marry the stock and hope for the best. And honestly, that part I like. If you are comfortable owning the shares at certain levels, selling puts can make sense. If you get assigned and the thesis is still intact, selling calls can make sense. You are getting paid to define your terms instead of panicking after the fact. Of course, if the business breaks, the strategy does not save you from bad stock selection. Nothing does. But when the name is volatile and the long-term theme is still alive, it is at least a rational approach. So where do I land going into this week? I think Palantir and SoFi are the cleanest conviction stories from the raw setup you gave me. Palantir because the market still has a huge appetite for visible AI winners with strong demand, even if expectations are dangerously high. SoFi because the business model looks more mature than the stock has often been willing to admit, and the next earnings date keeps that conversation close. Tesla is the opportunity with the most personality risk. IREN is the tactical infrastructure trade where the upside is real, but so is the need for discipline. And there is one more reason I do not think this is the week to sit around waiting for some perfect magical entry. Reuters has already been writing about markets bouncing back to records on diplomacy hopes, then wobbling again when oil spiked and the ceasefire picture looked less secure. That kind of tape usually does not reward hesitation. It rewards preparation. If you already know which names you trust, you can act when volatility gives you a price. If you do not, you end up reacting to every candle like it is a life event. And that is how people get trapped. They wait for total clarity, but total clarity never shows up. It just gets replaced by a higher stock price, a missed move, and a story they tell themselves about how they almost bought it. I do not want you trading almost. I want you trading a plan. Write it down before the bell and stick to it under pressure. Let me ask you something. Which one of these names would you still want to own if the market opened ugly tomorrow morning? And which one do you think has the best chance of surprising people over the next 2 weeks? And one more thing. If you are successful, share your success story in the comments so others can stay motivated. Because in markets like this, the real danger is not just being wrong. It is being emotional at exactly the wrong moment. Chasing strength, selling weakness, confusing headlines for analysis. Forgetting that one company can be great while the stock is still dangerous, and another can look boring while the business quietly gets stronger. That is where discipline beats drama. So yes, I think there are real opportunities here, but I also think this is the kind of tape that punishes sloppy thinking. Respect the calendar, respect the valuation, respect the consumer, respect the difference between a theme and a company. And do not let one green day convince you that risk disappeared. It did not. This is for education and research, not a permission slip to copy anybody's trades. I am sharing how I see the setup, not handing you a golden ticket. Do your own work, know your own risk, and make your own decisions like a grown-up.